What if I told you that Warren Buffett didn't build his fortune by chasing trends, timing the market, or listening to Wall Street noise? What if I told you that a handful of decisions, quiet, patient, and often misunderstood at the time, created one of the greatest financial empires in history? Today, we are not just talking about stocks. We are talking about moments, decisions, convictions that changed everything. Warren Buffett is often called the Oracle of Omaha. But the truth is far more fascinating. He didn't predict the future, he prepared for it. While others were distracted by hype, Buffett was studying balance sheets. While markets panicked, he stayed calm. And when the world doubted, he leaned in harder. The investments we're about to rank weren't obvious winners when he made them. In fact, many looked boring, outdated, or even risky. Yet they became the foundation of unimaginable wealth. This list is not about the most profitable stocks in history alone. It's about the most important investments, the ones that shaped Buffett's philosophy, refined his discipline, and proved that long-term thinking beats short-term excitement every single time. Some of these investments turned small sums into billions. Others taught painful lessons that sharpened Buffett's edge. And a few, they redefined entire industries. Here's what makes this story shocking. Buffett's greatest wins often came when the world was scared, when markets collapsed, when headlines screamed disaster, when investors ran for the exits. Buffett did the opposite. He bought certainty in moments of chaos. He invested not in numbers on a screen, but in businesses, people, and enduring value. As we count down Warren Buffett's 25 most important investments ever, ranked, you'll notice something powerful. There is a pattern, a mindset, a philosophy so simple that most people ignore it. Buffett didn't need thousands of stocks. He didn't need leverage or complicated strategies. He needed clarity, patience, and the courage to wait for the right moment, and then act decisively. Some of these investments began decades ago, when Buffett was still learning what it meant to be an investor. Others came later, when the world already knew his name. But every single one of them carries a lesson about risk, about human behavior, and about the power of compounding over time. This is not a story about overnight success. It's about delayed gratification. It's about saying no to hundreds of opportunities so you can say yes to the few that truly matter. Buffett once said that investing is simple, but not easy. The investments you're about to hear prove exactly why. If you've ever wondered how fortunes are really built, if you've ever questioned whether patience still works in a fast-moving world, if you've ever wanted to think like the greatest investor of all time, then stay with me. When we talk about Warren Buffett, most people immediately think of billions of dollars, Berkshire Hathaway, and the calm, grandfatherly figure delivering his annual letters. But behind that calm exterior lies a series of decisions so bold, so counterintuitive, and so shocking that even seasoned investors still study them today. Today, we're diving into the very beginning of Buffett's most important investments ever. These are not just financial moves. They are life lessons wrapped in market opportunities, and they reveal why Buffett became the man the world now calls the Oracle of Omaha. Let's start at the very beginning. Long before Buffett was buying entire companies, he was learning a simple but powerful rule. Invest in what you understand and ignore the noise. His first truly notable investment wasn't glamorous. It wasn't a tech startup or a flashy Wall Street play. No, it was a small textile company called Berkshire Hathaway. At the time, Buffett bought shares in what most people considered a dying business. But here's the twist. The strategy wasn't about the mill itself. It was about the value hidden in plain sight. Most investors saw a struggling company. Buffett saw a fortress of cash flow potential. He would later turn this seemingly ordinary investment into the foundation of an empire worth hundreds of billions. The lesson? Sometimes, the most shocking moves aren't about risk. They're about vision. Next, we move to a story that will shock you not for its glamour, but for its sheer audacity. In the 1960s, Buffett invested heavily in American Express, a company embroiled in scandal. Most investors ran for the exits when the so-called salad oil scandal hit the news, shaking American Express to its core. Shares plummeted and fear gripped Wall Street. But Buffett did something extraordinary. He bought more. Yes, he bet on recovery when everyone else bet on disaster. Why? Because he understood one of the most important principles of investing. The market often misprices value in times of panic. Buffett recognized that American Express's brand, its loyal customer base, and its future earning potential were far stronger than the temporary crisis suggested. That move alone would later deliver massive returns and cement Buffett's reputation as a fearless value investor. Fast forward a bit, and we arrive at an investment that is both shocking and profoundly educational: Coca-Cola. In 1988, Buffett purchased a stake in Coca-Cola that today would be worth tens of billions. Here's the kicker. Many critics at the time thought he was too late. Tech and industrial stocks were dominating headlines, and Coca-Cola was seen as old-fashioned. But Buffett's genius was in seeing brand dominance and long-term consumer loyalty as far more valuable than short-term trends. By betting on Coca-Cola, Buffett showcased another defining trait. He doesn't chase the latest fad. He identifies enduring value. In an era obsessed with novelty, he focused on consistency, trust, and timeless appeal. But investing isn't just about the wins. It's about timing and patience. Consider Geico, a company Buffett first bought in the 1950s. Insurance might not sound thrilling, but Buffett understood its potential better than anyone else. He saw a company that could scale, operate efficiently, and generate predictable profits for decades. The shocking part? He held on to it through turbulent times, patiently waiting for its full potential to be realized. That patience is what allowed Buffett to turn a modest investment into one of the most profitable holdings in Berkshire Hathaway's history. By now, a pattern begins to emerge. The first investments in Buffett's ranking share a few unmistakable traits. Clarity over complexity. Buffett invests in businesses he understands. He avoids companies he can't analyze. Courage over conformity. He often buys when others sell in panic and holds when others chase trends. Time over timing. Buffett doesn't need instant results. He bets on enduring growth. These lessons are not abstract. They are practical, actionable, and shocking in their simplicity. Many investors overcomplicate investing with algorithms, charts, and hype. Buffett proves that the most powerful investments come from disciplined thinking, patience, and conviction. As we continue through this countdown, you will see more of these principles in action, amplified by bold, sometimes shocking decisions that turned ordinary opportunities into extraordinary wealth. We're just getting started, and the best, most astonishing stories are still ahead. In Part 2, we'll explore Buffett's mid-career investments, the deals that shocked Wall Street, the companies that transformed entire industries, and the lessons about risk, timing, and human behavior that every serious investor must understand. Remember, this is not just about money. It's about seeing the world the way Warren Buffett sees it, full of opportunity, patience, and lessons hiding in plain sight. By now, you've seen Buffett's early moves, the foundation of his empire. But the real shockers start when we look at the investments that not only made him billions, but also transformed entire industries. Part 2 is about the deals that defined Buffett as more than an investor. They revealed a mindset that the world still struggles to understand. Let's start with Wells Fargo. Many investors today know it as one of America's largest banks, but Buffett saw something far deeper when he first invested. The banking sector was considered boring, slow-growing, and prone to crises. Most people avoided banks unless forced, but Buffett saw efficiency, trust, and consistent profitability. He understood that a bank with strong management and disciplined lending could generate decades of compounding returns. This is what separates Buffett from average investors. He doesn't look for excitement. He looks for predictability and long-term growth. His investment in Wells Fargo shocked analysts at the time because it went against the
Clarity
hype of
over
riskier,
complexity.
trendier sectors.
Buffett
But it later
invests
proved
in
one of
businesses
Berkshire
he
Hathaway's most
understands.
lucrative holdings.
He avoids
Next,
companies
we
he
arrive
can't
at a true
analyze.
shocker: Gillette. Consumer goods rarely make headlines in the fast-moving stock market, yet Buffett recognized a golden truth. Brands with pricing power and
Time
loyal
over
customers are
timing.
nearly
Buffett doesn't
untouchable.
need instant
Gillette's
results.
razors
He
dominated their
bets
market.
on enduring growth.
Competitors could copy the product, but not the brand loyalty. Buffett's insight was simple but revolutionary. Invest in businesses that control their own destiny, where profits don't disappear in a price war. That patience paid off spectacularly when Procter & Gamble acquired Gillette decades later, rewarding Berkshire Hathaway with enormous gains. Now, let's get controversial. Buffett's investments aren't always about smooth sailing. They're about turning crisis into opportunity. Consider Bank of America during the 2011 financial turbulence. While most investors ran, Buffett stepped in with a deal that shocked Wall Street. He bought preferred shares with a high dividend and received warrants for future stock purchases. Essentially, he was being paid to wait, while
In
also
part 2,
securing the right
we'll
to buy
explore
shares at a
Buffett's
discount.
mid-career investments,
move
the
embodies
deals that
Buffett's
shocked
genius,
Wall Street,
seeing opportunity
the
where others
companies
see
that
disaster,
transformed
and structuring
entire
deals
industries,
so that risk is
and
minimized
the
while
lessons
reward
about
potential
risk,
skyrockets.
timing,
Then
and
comes a
human
shocking leap
behavior
into
that
consumer
every
culture,
serious
the
investor
Kraft-Heinz
must
merger.
understand.
Many question
Remember,
Buffett's role
this is
in what
not
seemed
just
like a
about
risky
money.
consolidation. But once again, he was betting on strong brands, operational efficiency, and enduring consumer habits. While critics debated short-term profitability, Buffett focused on the long term. Businesses people rely on every single day, products that never go out of style. Buffett's mid-career investments also reveal a principle every investor should internalize. He rarely follows the crowd. He avoids tech fads, at least in his early career, and focuses instead on what he calls economic moats, companies with durable competitive advantages that protect profits from competitors. Coca-Cola and Gillette are textbook examples. Bank of America and Wells Fargo show his ability to turn fear into opportunity. Let's not forget the lesson of patience. Buffett doesn't rush. His mid-career holdings were carefully monitored for decades, often overlooked by analysts who wanted instant results. While the world chases quick gains,
Most
Buffett
people
demonstrates that true
avoided
wealth comes
banks
from letting
unless
time amplify
forced.
value.
But
And
Buffett
here's where it
saw
gets even more
efficiency,
shocking. Some
trust,
of Buffett's
and
biggest
consistent
insights weren't financial at all.
profitability.
They were
He
human
understood
insights.
that a bank with
studies
strong
management,
management
culture,
and disciplined
behavior.
lending
He
could
invests in
generate
people, not
decades
just
of
numbers.
compounding
That's why
returns.
companies with visionary,
This is what
disciplined management
separates
often
Buffett
appear in
from
his
average
portfolio.
investors.
Buffett
He
understands
doesn't
that
look for
numbers can lie,
excitement.
but people
He
rarely
looks
do.
for
And aligning with the
predictability
right
and
leadership can
long-term
turn a good
growth.
investment into a great one. As part 2 closes, remember this. Buffett's middle-era investments combine courage, patience, and human understanding. Each company he touches tells a story, not just of money, but of timing, trust, and the power of seeing value where others see risk. He doesn't just pick stocks, he shapes fortunes, transforms industries, and teaches lessons that go far beyond Wall Street. In part 3, we'll uncover the truly shocking late-career investments, companies that the market underestimated, global opportunities he seized, and the bold moves that secured Buffett's place as the most respected investor in history. These are the investments that show not just wealth creation, but the mind of a man who sees patterns no one else sees. Stay tuned, because the story of Buffett's 25 most important investments is far from over, and the next chapter will shock even seasoned investors. And just like that, we've walked through Warren Buffett's 25 most important investments, each one a masterclass in patience, vision, and courage. From the early days of Berkshire Hathaway to the bold mid-career moves that
Buffett.
shocked Wall Street,
Investments
and the late-career
aren't
deals that
always
solidified his
about
empire,
smooth sailing.
one thing
They're
becomes
about turning
abundantly
crisis into
Buffett doesn't just
opportunity.
invest in companies.
Consider
He
Bank of
invests in
America
enduring
during
value,
the
human
2011
ingenuity,
financial
and the power of time.
turbulence. While
about it.
most investors
Every
ran
investment on this list
Buffet
was made against the
stepped in
grain.
with a deal
The world
that
told him some
shocked
were too
Wall
risky,
Street.
others too
He
boring,
bought
and
preferred
some too
shares with a
controversial.
high dividend
Yet
and
Buffett
received
didn't follow the
warrants
crowd.
for future
He
stock
followed
purchases.
Principles that we can all learn from. Understand what you own, invest with conviction, and most importantly, be patient. The market may panic, trends may come and go, but true value always finds a way to reward those who wait. The shocking truth that ties all these investments together isn't just the billions of dollars they generated, it's the mindset behind them. Buffett saw beyond short-term noise, beyond headlines, beyond fear.
Many questioned
studied
Buffett's
businesses like
role
a
in what
scientist
seemed
studies
like a
nature,
risky
searching for patterns,
consolidation.
durability,
But
and
once
resilience.
again, he was
And he
betting
applied the
on
same
strong
scrutiny to
brands,
people,
operational
understanding that strong
efficiency,
leadership and
and
integrity were
enduring
just as
consumer
important as
habits.
numbers on a balance sheet.
While critics
For anyone who
debated
dreams of
short-term
financial freedom,
profitability,
wealth, or
Buffett
simply
focused
understanding how
on the
the richest
long-term
investors think,
businesses
the
people
takeaway is
rely on
clear.
every single
Stop
day,
chasing hype,
products
start
that
seeking
never
value,
go out of
and
style.
give time the power to work in your favor.
Buffett's mid-career
Buffett didn't become the
investments
Oracle of Omaha
also
overnight.
reveal a
It
principle
took
every
decades of
investor
careful
should
observation,
internalize.
calculated
He
risk-taking,
rarely
and
follows the
unwavering
crowd.
patience. Every investment, every lesson, every surprise on this list was part of that journey. So, what should you do after watching this video? Reflect, study, take these lessons and apply them to your own financial journey. You don't need billions to think like Buffett. You need discipline, curiosity, and the courage to act when the opportunity is right. Remember, investing isn't about following the crowd. It's about seeing what others overlook and having the conviction to act.